If you are an Indian mutual fund investor, you have probably hit this wall at some point. You want to diversify, you want some part of your portfolio outside India, maybe a slice of the US tech giants, maybe exposure to the Chinese economy, maybe even global energy or infrastructure plays. But when you go looking for options, what do you find? A very thin list. Maybe one or two international funds that have reopened for fresh subscriptions, and even those are capped. For instance, if you want to invest in China, a country that is the world's second largest economy, your choice basically comes down to just one or two funds. And even those are not always open for investment. You're stuck. And you might have wondered why. Why can't I just invest in global markets the same way an American or a Singaporean investor can? Well, the short answer is that because India, despite its growing economy and booming market, massively restricts capital flows, especially outward capital flows from Indian residents. And this is not by accident. It's a deliberate policy choice and it is rooted in India's unique economic history. But what if that changed? What if India opened the floodgates, lifted all restrictions on both inbound and outbound capital? What would that world look like? What lessons can we learn from other countries that have tried this? And should India move towards the future slowly or not at all? Let's break this down, not just with theory, but through a vivid thought experiment. If you're new here, I am Pranshuman. I've spent over a decade in corporate finance and investment banking, and on this channel, I try to unpack complex financial topics with nuance, data, and real world relevance. Subscribe if you find this kind of clarity useful, and join our Telegram group. The link is in the description, where we go deeper into topics like this and more. Let's begin with the basics. India's capital account is not fully convertible, which means that you cannot freely move money in or out of the country for capital investments without restrictions. Trade related transactions, that is, the current account, are mostly open. You can import goods, travel abroad, pay for education, medical treatment, and so on. But when it comes to capital like buying property abroad, investing in US stocks, setting up a company overseas, or even just transferring money to a foreign account, the system is tightly controlled. Individuals are allowed to remit up to $250,000 per year under the Liberalized Remittance Scheme or LRS, but this limit fluctuates based on macroeconomic pressure. In fact, during periods of dollar stress like in 2022, even that channel was temporarily choked off. Indian mutual funds investing overseas were also forced to pause fresh inflows, not because of their own portfolio decisions, but because the Reserve Bank of India had hit its ceiling on overseas limits. So, yes, India does restrict capital flows, especially outbound ones, and inbound flows are also managed carefully. Foreign direct investment or FDI is welcome, but it comes with sectoral caps, approval routes, and regulatory filters. Foreign portfolio investors or FPIs must navigate debt market restrictions, minimum maturity limits, and sector specific guidelines. This is not a fully open economy. And again, this is by design. It is not because policymakers don't know better. It is because they are managing trade offs between openness and stability and between growth and volatility. But let's do a thought experiment. Imagine that tomorrow all capital controls are lifted. India becomes fully convertible on its capital accounts. No more LRS limits, no sectoral caps on FDI, no restriction on FPIs. Individuals can invest anywhere in any amount. Foreigners can invest freely in India, come and go as they please, and the rupee becomes fully convertible, like the dollar or the euro. Well, what will happen next? In the short term, we'd likely see chaos in the currency markets. Indian residents, especially HNIs and upper middle class investors, will begin diversifying out immediately. Everyone from startup founders to salaried professionals will start parking money abroad. Dollar demand would surge and the rupee would depreciate, possibly very sharply. In a matter of weeks, we could see a 10 to 20% correction in the rupee. This would be exacerbated by speculators shorting the currency, betting on further depreciation. And the RBI, stripped of its capital control tools, will be limited in how it would respond. Meanwhile, Indian mutual funds, which are already under pressure, would see redemptions from global exposure seeking investors. Domestic equity markets could see initial outflows as domestic capital searches for diversification and perceived safety abroad. On the other hand, some foreign investors would see opportunity in India. With a falling rupee and cheap Indian assets, there would be opportunistic inflows into real estate, distressed assets, and perhaps even listed stocks. But long term institutional investors will likely wait for stability before committing more capital. Then there is the impact of the banking system. Indian corporates will start borrowing abroad, where interest rates are often lower. They would reduce their dependence on Indian banks, which would shrink the domestic deposit base as well. Indian banks could see a liquidity crunch, especially if domestic savers begin parking funds abroad. Foreign banks, meanwhile, would enter aggressively, bringing competition but also regulatory complexity. Real estate capital flight would become very common. Indians would start buying flats in Dubai, Singapore, and London, not for utility but for capital preservation. This would mirror what we have seen in Chinese investors in Vancouver and New York. At home, luxury real estate could weaken as HNIs diversify away. On the other hand, developers focused on the mid segment may benefit as HNRI money returns for projects targeting returning or globally mobile Indian families. Different groups would respond differently. Middle class investors would finally get access to foreign assets, but without financial literacy, many could take excessive risks chasing quick gains abroad. HNIs would set up overseas family offices, permanently shifting wealth abroad. Corporates would restructure holding companies in tax friendlier jurisdictions, and students would find it easier to fund foreign educations. The impact on macroeconomic stability would be very significant. India runs a persistent current account deficit of about 1 to 2% of GDP. With full convertibility and no restriction on capital movement, this deficit becomes a risk magnet. Any global risk off event, like say a US recession or a geopolitical shock, could trigger rapid capital flight. India's forex reserves, while large in absolute terms, are modest when measured in per capita or against total external liabilities. We have seen how this played out in Southeast Asia in the 1990s. Now, let's take a moment here and learn from history. Thailand, Indonesia, and South Korea in the early 1990s liberalized capital accounts quickly under IMF guidance. Money flowed in, currencies were pegged to the dollar, and economies boomed. But when sentiment turned, it all collapsed. Thailand was the first domino, followed by Indonesia and then Korea. Currencies crashed, foreign debt could not be repaid, and IMF bailouts came with very painful austerity measures. Tens of millions fell into poverty. Russia tried shock liberalization in the 1990s, full openness with weak institutions. The result? Capital flight, currency collapse, and a full blown default in 1998. Argentina has opened and closed its capital account multiple times over the past few decades, with each cycle ending in inflation, devaluation, and debt restructuring. Now contrast that with Chile, a country that liberalized gradually. It retained restrictions on short term speculative flows, built institutional capacity, and eventually integrated into global markets very smoothly. Or South Korea, which crashed in 1997 but used the crisis to reform, strengthen, and reopen with discipline. So, the lesson from all these examples is clear. Capital account liberalization cannot be rushed. It must be sequenced, it must be earned, and it must be paired with macroeconomic resilience, deep domestic markets, strong regulatory institutions, and a public that understands the risks and responsibilities that come with financial freedom. So, where does that leave India? Should India move towards full capital account convertibility? Yes, but gradually and with clear preconditions. The long term benefits of liberalization are real. Indian investors deserve global diversification. Indian firms need access to global capital, and India's inclusion in global financial indices will require openness. There is no reason why a $5 trillion economy should still be operating with a post colonial mentality of forex rationing. But here's the catch: to get there safely, we must first build the foundations. First, macroeconomic resilience. Keep the current account deficit within manageable levels, maintain strong forex reserves, and reduce reliance on short term external debt. Second, deepen domestic markets, especially the corporate bond market, currency derivatives, and financial literacy infrastructure. Third, reform incrementally. For example, raise the LRS limits from 250k to 500k per person. Allow mutual funds broader access to overseas markets with safeguards. And permit Indian startups to list abroad with transparency, avoiding the Singapore and Delaware holding company trend. Finally, retain flexibility. Use tools like capital buffers, tax disincentives for hot money, and unhedged exposure caps to manage risks without banning inflows entirely. If done right, capital account liberalization can be India's gateway to deeper integration with the global economy, allowing us savers to invest globally, our firms to compete globally, and our currency to eventually earn a seat at the global table. To circle back, the next time you feel frustrated that you can't invest in a US ETF or a Chinese tech fund from your Indian mutual fund app, remember, it's not incompetence, it is not regulatory apathy, it's caution. And in a world where capital can panic faster than governments can respond, caution is not always a bad thing. If you found this breakdown useful, make sure to like this video, subscribe to the channel, and share it with others who are curious about how global economies affect us right here at home. Also, don't forget to join the Telegram group. We continue these discussions there with more depth, real time data, and community insights. The link is in the description. Until next time, stay curious, stay informed, and invest wisely.